Today, we're going to discuss a crucial concept that many investors overlook: the difference between reflective descriptions of past events and universal principles, and why this distinction is critical for avoiding financial loss. We often hear statements like, "The rise was spectacular and the fall was devastating," when people talk about the stock market, particularly when referring to historic events such as the 1929 crash or the 2008 financial crisis. These descriptions are powerful, they resonate emotionally, and they certainly capture the magnitude of what happened during those times. But here's the important thing: such descriptions are reflective, not universal principles. What does that mean? Reflective descriptions simply describe what has happened in a specific context. They are based on actual past events, and they convey the intensity or scale of those events. For example, during the 1929 stock market crash, the rise in stock prices was indeed spectacular, and the subsequent fall was devastating. But these are just descriptions of that period in history. They don't tell us that every market rise will be spectacular or every market crash will be devastating. Universal principles, on the other hand, are consistent rules or patterns that apply universally, regardless of time, place, or specific circumstances. For example, supply and demand is a universal principle that influences all markets. However, not every rise in the market is followed by a crash, and not every market crash is the result of speculative bubbles. Now, why is this distinction important? Many investors, particularly those new to the financial markets, fall into the trap of mistaking reflective descriptions for universal principles. They see patterns in past events, such as a market rise followed by a crash, and assumed this is always how markets behave. This leads to overconfidence during periods of market growth and panic during downturns. For instance, after witnessing the booms and busts of the 1920s or 2008, some investors believe that the market is inevitably heading toward another crash whenever it rises too quickly. Others, during a downturn, might assume that the entire market will collapse for good. This mindset can be extremely dangerous. The truth is, markets are driven by a wide range of factors: economic conditions, investor psychology, government policies, global events, and technological advancements. What happened in 1929 or 2008 was shaped by specific factors at that time. And while historical trends are helpful for understanding the past, they do not guarantee the future. So what should we take away from this? Be cautious about applying past patterns as future certainties. The market is unpredictable, and while history can offer valuable insights, it is not a blueprint for future outcomes. Develop a solid understanding of market fundamentals. Focus on data-driven strategies, risk management, and long-term trends. Diversification and proper asset allocation are key to managing the inevitable fluctuations in the market. Understand the psychology of the market. Markets are heavily influenced by human behavior, which means that emotions like fear and greed can lead to irrational decisions. Being aware of this can help you avoid the herd mentality that often leads to losses. Learn from the past, but don't be bound by it. The rise and fall of markets will always be influenced by various forces, but not every pattern will repeat in exactly the same way. In conclusion, while the spectacular rise and devastating fall of the market is an interesting and dramatic description of certain historical events, it is not a universal principle. To be a successful investor, we must understand the difference between reflective descriptions of the past and the fundamental principles that govern market behavior today. By doing so, we can make more informed, rational decisions and avoid the pitfalls that lead to financial loss. Thank you for your attention, and I hope this helps you understand the critical importance of distinguishing between the descriptive and the universal in your investment strategy.